Question 1. Which of the following best explains the difference between fixed and variable annuities? A. Fixed annuities offer predictable payments, while variable annuities payments are based on the performance of underlying investments. B. Fixed annuities are designed for high-risk investors, while variable annuities are designed for conservative investors. C. Fixed annuities provide market-based returns, while variable annuities guarantee fixed income streams. D. Fixed annuities can be transferred to variable annuities without any penalties. Answer A. Fixed annuities offer predictable payments, while variable annuities payments are based on the performance of underlying investments. Explanation: fixed annuities guarantee a specified payment amount, providing a steady income stream. This predictable payout comes regardless of market conditions. In contrast, variable annuities involve investment choices, and the annuity payments fluctuate depending on the performance of those investments, e.g., mutual funds, stocks, or bonds. This difference is crucial when considering the risk profiles of the annuity holder and their goals. The other options are incorrect because they confuse the definitions of fixed and variable annuities and their intended uses. Question 2. Scenario: Mr. Daniels is nearing retirement and wants to invest in an annuity that provides him with a guaranteed income for life. However, he is concerned about inflation affecting the purchasing power of his income over time. Which annuity payout option should Mr. Daniels consider to address his concern? A. Straight life annuity. B. Life annuity with period certain. C. Inflation protected annuity. D. Joint and survivor annuity. Answer: C. Inflation protected annuity. Explanation: an inflation-protected annuity includes an inflation adjustment which helps maintain the purchasing power of the income over time by increasing the payment amount periodically, usually tied to an inflation index like the Consumer Price Index (CPI). This addresses Mr. Daniels' concern about inflation. The other options are less suited for inflation protection. A straight life annuity provides lifetime income but does not adjust for inflation, meaning purchasing power could decrease over time. B. A life annuity with period certain guarantees payments for life or a specified period but still does not account for inflation. D. A joint and survivor annuity provides lifetime income for two individuals but lacks inflation adjustments unless specifically designed as an inflation-protected option. Question 3. Which of the following is a primary advantage of annuities as a retirement income strategy? A. Annuities provide tax-deferred growth, meaning you do not pay taxes on the earnings until you start receiving payments. B. Annuities are exempt from surrender charges during the accumulation phase. C. Annuities guarantee a return on investment regardless of market conditions. D. Annuities allow for unlimited contributions without any tax consequences. Answer A. Annuities provide tax-deferred growth, meaning you do not pay taxes on the earnings until you start receiving payments. Explanation: the primary advantage of annuities as a retirement income strategy is the tax deferral on earnings. This allows your investments to grow without the burden of annual tax payments until withdrawals are made, typically during retirement. This feature is particularly beneficial for individuals looking to reduce their taxable income while accumulating retirement funds. B. Surrender charges can apply during the early years of an annuity contract depending on the terms of the annuity. C. Annuities do not guarantee a return on investment. In the case of variable annuities, the return depends on the performance of the underlying investments, and even fixed annuities may not always outperform inflation or market averages. D. There are annual contribution limits for qualified annuities, and non-qualified annuities are subject to the contributions of the individual, meaning they are not unlimited. Question 4. Which of the following is true regarding the taxation of non-qualified annuities? A. The entire annuity payment is taxable, including both principal and interest. B. Only the interest portion of the annuity payment is taxable, while the principal is tax-free. C. Both the principal and interest are taxed at a lower rate than other income sources. D. The interest portion is taxed only after the annuitant reaches age 65. Answer B. Only the interest portion of the annuity payment is taxable while the principal is tax-free. Explanation: in non-qualified annuities, the principal, the amount that was originally invested, is not taxable while the interest or earnings are taxed as ordinary income when withdrawn. This is the tax-deferred nature of non-qualified annuities. The other options are incorrect because A. The principal is not taxable in a non-qualified annuity, only the earnings are taxed. C. Non-qualified annuities do not receive preferential tax treatment in terms of tax rates, so they are taxed at ordinary income rates. D. Taxes on the interest portion begin when withdrawals are made, not based on the annuitant's age. Question 5. Which type of annuity allows the annuitant to make periodic withdrawals of funds but also includes a minimum guaranteed withdrawal amount? A. Fixed annuity. B. Variable annuity. C. Guaranteed minimum withdrawal benefit double-eyed. D. Joint and survivor annuity. Answer: C. Guaranteed minimum withdrawal benefit double-eyed. Explanation: a guaranteed minimum withdrawal benefit double-eyed is an additional feature that can be attached to variable annuities. It guarantees the annuitant the right to withdraw a specified percentage of their original investment regardless of the market performance for a certain period. This offers a minimum level of income security while still allowing for periodic withdrawals. A fixed annuity does not include the ability for withdrawals to be made while maintaining a guarantee of minimum withdrawal amounts. B. A variable annuity provides investment options that can fluctuate with market performance but does not guarantee a specific withdrawal amount. D. A joint and survivor annuity provides income for two individuals but does not address withdrawal guarantees. Question 6. Scenario: Mrs. Roberts is considering replacing an existing fixed annuity with a new variable annuity. The new annuity includes high surrender charges and has different investment options. What should Mrs. Roberts do to ensure that this transaction is in her best interest? A. Proceed with the exchange, as variable annuities generally offer higher returns. B. Review the suitability of the replacement and make sure she fully understands the surrender charges and investment risks. C. Replace the annuity immediately to avoid any market downturns that could affect her current annuity. D. Select a lower cost annuity with fewer investment options to simplify her portfolio. Correct answer: B. Review the suitability of the replacement and make sure she fully understands the surrender charges and investment risks. Explanation: before replacing an annuity, the annuity seller must conduct a suitability review to ensure the new product meets the customer's financial needs. This includes understanding the surrender charges of the old contract, the risks involved with the new investment options, and whether the new product is appropriate given Mrs. Roberts' financial goals, age, and risk tolerance. It's not just about higher returns. The suitability is key, and replacing an annuity can have significant long-term financial consequences. C. Market downturns do not justify replacing an annuity. The decision must be based on a careful review of the product features and the customer's needs. D. Simplifying the portfolio may not align with the customer's financial goals and may not always be the right choice. Question 7. Which of the following payout options provides an annuitant with a guaranteed income for life with payments continuing to a beneficiary if the annuitant dies early? A. Life annuity with period certain. B. Straight life annuity. C. Fixed period annuity. D. Joint and survivor annuity. Answer: A life annuity with period certain. Explanation: a life annuity with period certain guarantees payments for the annuitant's lifetime, and if the annuitant dies before the end of the specified period certain, e.g. 10 years, the remaining payments will go to a beneficiary. This ensures that the annuitant's beneficiary will receive payments even if the annuitant dies prematurely. B. A straight life annuity provides payments only for the life of the annuitant, with no benefit to a beneficiary if the annuitant dies early. C. A fixed period annuity provides income for a fixed period, but payments stop when that period ends, regardless of whether the annuitant is alive or not. D. A joint and survivor annuity provides lifetime payments for two people, typically a couple, but it does not have the same period certain feature that guarantees payments to a beneficiary if the annuitant dies early. Question 8. Which of the following best describes a variable annuity's investment options? A. Variable annuities allow the annuitant to choose from a range of fixed income and equity-based sub-accounts. B. Variable annuities invest solely in fixed income securities, offering no exposure to the stock market. C. Variable annuities offer no choice of investments and are fully managed by the insurance company. D. Variable annuities only offer investment choices related to short-term government bonds. Answer: 8. Variable annuities allow the annuitant to choose from a range of fixed income and equity-based sub-accounts. Explanation: variable annuities provide the annuitant with a selection of investment sub-accounts including both equity, stocks, and fixed income bonds options. The annuitant's choice of investments determines the performance of the annuity and therefore the value of their payouts. B. Variable annuities are not limited to fixed income securities, as they provide exposure to a variety of investment types. C. Variable annuities provide investment choices for the annuitant, which distinguishes them from fixed annuities. D. Variable annuities offer a broader range of investment options than just short-term government bonds. Question 9. What does the exclusion ratio refer to in relation to annuities? A. The percentage of an annuity payment that is guaranteed to be tax-free. B. The ratio of the annuity's premium to its accumulated earnings used to calculate the taxability of annuity payments. C. The amount of interest that is taxed each year during the accumulation phase of the annuity. D. The percentage of a lump sum payment that is excluded from taxation upon withdrawal. Answer: B. The ratio of the annuity's premium to its accumulated earnings used to calculate the taxability of annuity payments. Explanation: the exclusion ratio is used to determine the taxable and non-taxable portions of annuity payments. It calculates the portion of each payment that is a return of the original investment, which is not taxable, and the portion that is earnings, which is taxable. The ratio is typically calculated by dividing the total premium paid into the annuity by the expected return, which includes both the principal and interest. The exclusion ratio is not a guarantee, it's a method for calculating how payments will be taxed. C. Interest is taxed upon withdrawal, but the exclusion ratio is specifically for calculating the taxable portion of annuity payments. D. The exclusion ratio does not apply to lump sum withdrawals, it is used for periodic annuity payments. Question 10. Which of the following statements about annuity sales and suitability is true? A. Suitability regulations require the agent to recommend an annuity that aligns with the client's financial goals and needs, even if it is more costly than other options. B. The agent is obligated to sell the most expensive annuity regardless of its suitability for the client's needs. C. A suitability review must consider the client's risk tolerance, age, and financial situation before recommending an annuity. D. Annuities must only be sold to clients aged 65 and older. Answer: C. A suitability review must consider the client's risk tolerance, age, and financial situation before recommending an annuity. Explanation: the suitability standards under the California Insurance Code and the NAIC Model Annuity Suitability Regulation require that agents conduct a thorough analysis of a client's financial situation, risk tolerance, age, and goals before recommending an annuity. This ensures that the annuity meets the client's needs and is appropriate for their financial plan. A. The recommendation must be based on the client's needs and financial situation, not just the cost of the annuity. B. The agent is not obligated to sell the most expensive product. The focus is on suitability. D. Annuities can be sold to clients of any age as long as the product is appropriate for their needs and financial goals. Question 11. Which of the following types of annuities guarantees that the annuitant will receive income for a specified period of time even if they die before that time period expires? A. Joint and survivor annuity. B. Fixed period annuity. C. Life annuity. D. Immediate annuity. Answer: B. Fixed period annuity. Explanation: a fixed period annuity guarantees that income will be paid to the annuitant for a fixed period, such as 10 or 20 years. If the annuitant dies before the end of the period, the remaining payments are made to a beneficiary. A joint and survivor annuity is for two people and provides income for both lives. C. A life annuity only pays income for the annuitant's lifetime with no guarantee for the beneficiary if the annuitant dies early. D. An immediate annuity begins payments immediately after the premium is paid, but it does not guarantee a fixed period of income. Question 12. Which of the following describes a lifetime income rider attached to a variable annuity? A. It guarantees a fixed interest rate for the annuity's entire duration. B. It guarantees the annuitant a fixed income for life, regardless of market performance. C. It guarantees the annuitant a lump sum payment at death. D. It increases the annuity payments over time based on the annuitant's age. Answer: B. It guarantees the annuitant a fixed income for life, regardless of market performance. Explanation: a lifetime income rider on a variable annuity guarantees the annuitant a fixed income for life even if the investments in the sub-accounts perform poorly. It provides a level of income security despite the risks associated with the variable annuity's market-driven returns. A. The lifetime income rider doesn't guarantee a fixed interest rate, it guarantees income for life. C. It does not guarantee a lump sum payment at death, it focuses on lifetime income. D. The rider does not automatically increase payments over time. Question 13. Which of the following would be the most appropriate reason for an individual to purchase a deferred annuity? A. To receive a lump sum payment upon retirement. B. To provide income for a specific term, such as 10 years. C. To accumulate funds for retirement on a tax-deferred basis. D. To ensure the annuity payments increase annually to match inflation. Answer: C. To accumulate funds for retirement on a tax-deferred basis. Explanation: deferred annuities are purchased to accumulate funds over time on a tax-deferred basis, allowing the annuitant to build savings that will be used for future income. These funds can be accessed at a later date, often during retirement. A deferred annuity doesn't provide a lump sum, it provides periodic income. B. A fixed period annuity would be a better option for receiving income for a specific term. D. Inflation protection requires a different type of annuities, such as a cost of living rider. Question 14. An annuitant's withdrawal from a fixed annuity before the contract surrender period ends will result in which of the following consequences? A. The annuitant will receive a refund of the principal paid. B. The annuitant may incur surrender charges. C. The annuitant will lose all of the interest earned. D. The annuitant will be exempt from any early withdrawal penalties. Answer: B. The annuitant may incur surrender charges. Explanation: if an annuitant withdraws funds from a fixed annuity before the end of the surrender period, they may incur a surrender charge, which is a penalty for early withdrawal. This charge typically decreases over time. A. The principal is typically refunded, but there will be charges or penalties involved for early withdrawal. C. The annuitant will usually not lose all the interest earned, though some of it may be forfeited. D. Early withdrawal penalties usually apply unless there is a specific exemption. Question 15. Which of the following is a primary advantage of purchasing a fixed annuity over a variable annuity? A. Fixed annuities offer unlimited growth potential based on market performance. B. Fixed annuities guarantee a fixed rate of return for the life of the contract. C. Fixed annuities allow for higher levels of customization in investment options. D. Fixed annuities offer tax advantages over variable annuities. Answer: B. Fixed annuities guarantee a fixed rate of return for the life of the contract. Explanation: fixed annuity offers a guaranteed fixed interest rate, providing a stable return on investment for the duration of the contract, regardless of market performance. A. Variable annuities, not fixed annuities, offer growth potential based on market performance. C. Fixed annuities typically offer less customization than variable annuities, which have a variety of investment options. D. Both fixed and variable annuities have the same tax advantages as they are both tax-deferred products. Question 16. Which of the following features is unique to a variable annuity compared to a fixed annuity? A. Guaranteed interest rate. B. Flexibility in choosing investments from a range of sub-accounts. C. Fixed income payments for life. D. No market risk. Answer: B. Flexibility in choosing investments from a range of sub-accounts. Explanation: variable annuities allow the annuitant to choose from a variety of sub-accounts, e.g. stocks, bonds, and mutual funds, with the value of the annuity fluctuating based on the performance of these investments. Fixed annuities offer a guaranteed interest rate, while variable annuities do not. And C. Fixed annuities provide guaranteed income, while variable annuities do not guarantee income payments and depend on market performance. D. Variable annuities carry market risk, unlike fixed annuities, which provide a stable, guaranteed return. Question 17. What is the main disadvantage of choosing a life annuity without a guaranteed period? A. The annuitant may receive a lower income for a longer period than expected. B. The annuitant risks receiving no income if they die prematurely. C. The annuitant's income will be taxable at a higher rate. D. The annuity payments may increase each year, making the total payout unpredictable. Answer: B. The annuitant risks receiving no income if they die prematurely. Explanation: a life annuity without a guaranteed period only provides income for the annuitant's lifetime. If the annuitant dies prematurely, no payments are made to beneficiaries and the invested principal may not be fully recovered. A. The annuitant will receive income for their lifetime, but the amount may not be guaranteed if they die early. C. Income from a life annuity is taxable, but this is not related to the type of annuity chosen. D. Life annuities with no guaranteed period do not offer increasing payments. Question 18. What does the term surrender charge refer to in an annuity contract? A. A fee charged for making a late payment. B. A fee imposed for transferring funds between investment options. C. A penalty for early withdrawal during the surrender period. D. A charge for annuity riders. Answer: C. A penalty for early withdrawal during the surrender period. Explanation: The surrender charge is a penalty imposed when the annuitant withdraws funds from the annuity during the surrender period, typically the first few years of the contract. These charges are designed to discourage early withdrawals. A late payment fee is not related to the surrender charge. B. Transfers between sub-accounts may involve fees but are not surrender charges. D. Annuity riders are additional benefits, but their cost is separate from surrender charges. Question 19. Which of the following statements about a fixed annuity's death benefit is true? A. The death benefit is typically the full amount of premiums paid into the annuity. B. The death benefit will always be less than the total amount invested in the annuity. C. The death benefit only applies if the annuitant dies before receiving any payments. D. The death benefit is based on the performance of the underlying investments. Answer A. The death benefit is typically the full amount of premiums paid into the annuity. Explanation. In a fixed annuity, if the annuitant dies during the accumulation phase or before the payments begin, the death benefit is generally equal to the total premiums paid, sometimes with interest. This ensures the beneficiary receives a benefit. B. The death benefit generally reflects the premiums paid or the contract's value, but not typically less than the investment. C. Death benefits apply to any time during the contract, whether or not payments have started. D. Fixed annuities do not depend on the performance of underlying investments. Question 20. What is the primary purpose of an annuity's accumulation phase? A. To convert the accumulated value into a stream of periodic payments. B. To accumulate funds that grow on a tax-deferred basis before income payments begin. C. To pay out fixed income to the annuitant. D. To guarantee a specific income amount regardless of market conditions. Answer. B. To accumulate funds that grow on a tax-deferred basis before income payments begin. Explanation. The accumulation phase of an annuity is the period during which the annuitant makes contributions or allows their invested funds to grow. This phase allows the money to grow on a tax-deferred basis, meaning taxes are not owed on the earnings until funds are withdrawn or the annuitant starts receiving payments. A. This refers to the annuitization phase, not the accumulation phase. C. Fixed income payments occur after the annuitization phase, not during accumulation. D. While some annuities offer guarantees, this is not the primary purpose of the accumulation phase. Question 21. Which of the following statements best describes the exclusion ratio used in the taxation of non-qualified annuities? A. It determines the portion of each annuity payment that is considered taxable. B. It calculates the portion of each annuity payment that is tax-free. C. It applies to the earnings portion of the annuity and is only applicable to qualified annuities. D. It refers to the penalty applied to early withdrawals from non-qualified annuities. Answer. B. It calculates the portion of each annuity payment that is tax-free. Explanation. The exclusion ratio is used to determine the tax-free portion of each annuity payment from a non-qualified annuity. This ratio is calculated by dividing the amount of the original investment, the cost basis, by the total expected return. The resulting percentage is applied to each payment to determine the tax-free portion. A. The exclusion ratio applies to tax-free portions, not taxable amounts. C. The exclusion ratio specifically applies to non-qualified annuities, not qualified ones. D. Early withdrawal penalties are separate from the exclusion ratio. Question 22. Which of the following is a key feature of variable annuities? A. Payments are based on a fixed interest rate. B. The value of the annuity is tied to the performance of underlying investments. C. They offer guaranteed income payments for life regardless of market performance. D. All withdrawals are tax-free. Answer. B. The value of the annuity is tied to the performance of underlying investments. Explanation. Variable annuities allow the annuitant to allocate premiums among various investment options, such as stocks, bonds, or mutual funds. The value of the annuity fluctuates with the performance of these investments. A. Variable annuities do not provide fixed interest rates. They are dependent on market performance. C. While variable annuities may offer optional riders for guaranteed income, the base annuity is not guaranteed. D. Withdrawals from variable annuities are not tax-free. They are subject to taxation on earnings. Question 23. In the context of annuities, what is the difference between an immediate annuity and a deferred annuity? A. Immediate annuities start payments immediately, while deferred annuities start payments at a future date. B. Immediate annuities have higher premiums than deferred annuities. C. Deferred annuities provide payments in equal intervals, while immediate annuities provide lump sum payments. D. Immediate annuities are only available to retirees, while deferred annuities are for younger investors. Answer: A. Immediate annuities start payments immediately, while deferred annuities start payments at a future date. Explanation: the key difference between an immediate and a deferred annuity is the timing of the first payment. An immediate annuity begins payments right after the premium is paid, whereas a deferred annuity delays payments until a later date. B. Premiums for both types of annuities can vary, but the primary difference is when payments begin. C. Immediate annuities provide periodic payments, not lump sums. D. Both types of annuities are available to a wide range of investors, not just retirees or younger investors. Question 24. Which of the following annuity riders provides protection against the risk of long-term care needs? A. Guaranteed minimum withdrawal benefit double ride. B. Long-term care LTC rider. C. Death benefit rider. D. Inflation protection rider. Answer: B. Long-term care LTC rider. Explanation: the long-term care rider is specifically designed to provide benefits in the event the annuitant requires long-term care services. This rider is often added to annuities to help pay for the costs of care due to illness or disability. The GMWB provides a minimum withdrawal guarantee, not long-term care coverage. C. Death benefit riders provide a death benefit to the beneficiary, not long-term care benefits. D. Inflation protection riders adjust payments to account for inflation, not long-term care needs. Question 25. When an annuity is used to fund a tax-qualified retirement plan, G era, what is the tax treatment of the premiums paid? A. Premiums are taxable as income in the year they are paid. B. Premiums are tax deferred and grow tax-free until distributions are made. C. Premiums are taxed immediately, but gains are tax deferred. D. Premiums are not tax deductible, but the annuity payments are tax-free. Answer: B. Premiums are tax deferred and grow tax-free until distributions are made. Explanation: premiums paid into a tax-qualified retirement plan, such as an IRA or 401k, are made with pre-tax dollars, and the funds grow tax-deferred. Taxes are owed only when the funds are withdrawn. A. Premiums for tax-qualified plans are not taxable when paid. They are tax-deferred. C. While earnings grow tax-deferred, premiums themselves are not taxed immediately. D. Annuity payments are taxed as ordinary income upon distribution, not tax-free. Question 26. Scenario-based. Mr. Thompson is considering replacing an existing annuity with a new one. The new annuity offers better terms, including a higher guaranteed income, but the replacement would involve surrender charges on the old annuity. What should Mr. Thompson consider before making this decision? A. He should proceed with the replacement because the higher income will provide more immediate benefits. B. He should carefully evaluate the surrender charges, tax consequences, and suitability of the new annuity based on his needs. C. He should rely solely on the opinion of the agent selling the new annuity. D. He should replace the old annuity without considering the charges, since the new annuity is more attractive. Answer: B. He should carefully evaluate the surrender charges, tax consequences, and suitability of the new annuity based on his needs. Explanation: before replacing an annuity, Mr. Thompson should consider all relevant factors such as surrender charges, any tax penalties, the benefits of the new annuity, and whether the replacement is suitable for his financial goals. Regulatory guidelines, such as those in California's insurance code, emphasize the importance of suitability in the sale of annuities, including the potential for loss in replacing an existing annuity. While higher income is appealing, surrender charges and other factors may outweigh the benefits. C. Relying solely on the agent's opinion could lead to biased advice. Independent evaluation is critical. D. Replacing an annuity without considering the consequences could lead to financial loss or tax penalties. Question 27. Which of the following is true regarding the taxation of annuities during the distribution phase? A. The entire payment amount is subject to taxation if the annuity is non-qualified. B. Only the principal portion of the payment is taxable and the earnings are tax-free. C. The earnings portion of the annuity payment is taxed as ordinary income. D. Payments from a qualified annuity are tax-free after the annuitant turns 59(1)(2). Answer: C. The earnings portion of the annuity payment is taxed as ordinary income. Explanation: for non-qualified annuities, the earnings portion of the payment is taxed as ordinary income. The principal or original investment is not taxed again, as it was already taxed when it was initially earned. A. Only the earnings are taxable, not the entire payment amount. B. The principal is not taxed again. Only the earnings are subject to taxation. D. Qualified annuities are taxable when distributions are made, regardless of the annuitant's age. Question 20. What is the main advantage of a fixed annuity compared to a variable annuity? A. Fixed annuities offer higher potential returns than variable annuities. B. Fixed annuities provide guaranteed periodic payments regardless of market performance. C. Fixed annuities allow the annuitant to invest in a wide range of assets. D. Fixed annuities offer tax-free growth of the accumulated funds. Answer: B. Fixed annuities provide guaranteed periodic payments regardless of market performance. Explanation: Fixed annuities provide a set guaranteed income for the annuitant, which is not dependent on market fluctuations. This predictability is a key advantage over variable annuities, whose payments fluctuate based on the performance of underlying investments. Variable annuities have the potential for higher returns, but they also carry higher risks. C. Fixed annuities do not allow the annuitant to invest in assets like variable annuities do. D. Fixed annuities grow on a tax-deferred basis, not tax-free. Question 29. Which of the following best describes an inflation protection rider on an annuity? A. It guarantees that annuity payments will never decrease, even in times of market downturns. B. It allows the annuity payment amount to increase over time to keep pace with inflation. C. It reduces the premium payments for the annuity if inflation exceeds a certain rate. D. It provides a lump sum payment if inflation exceeds a specified threshold. Answer: B. It allows the annuity payment amount to increase over time to keep pace with inflation. Explanation: An inflation protection rider on an annuity allows the annuity payments to increase over time, typically in line with inflation or a fixed percentage. This rider is designed to help ensure that the purchasing power of the annuity payments doesn't decrease due to inflation. While some annuities may offer protection against decreasing payments, this is not the primary function of an inflation protection rider. C. Inflation protection riders do not reduce premium payments. They focus on increasing the payout amount over time. D. A lump sum payment based on inflation is not a feature of the inflation protection rider. Question 30. Which of the following factors can influence the value of a variable annuity? A. The interest rate set by the insurance company. B. The performance of the underlying investments in the annuities portfolio. C. The age of the annuitant. D. The amount of premium payments made into the annuity. Answer: B. The performance of the underlying investments in the annuities portfolio. Explanation: The value of a variable annuity is directly linked to the performance of the investments chosen by the annuitant, such as stocks, bonds, or mutual funds. As these investments perform well or poorly, the annuity value will fluctuate. A. The interest rate set by the insurance company affects fixed annuities, not variable annuities. C. The age of the annuitant can affect payout options, but it does not influence the value of a variable annuity. D. The amount of premium payments contributes to the annuity's value, but it is the investment performance that determines how the value changes over time.